Hello, everyone. Welcome to the Big Beautiful Bill, or OBA, or One Big. The official act is called the One Big Beautiful Bill Act. So, welcome. Today, we're going to go over everything about the bill and just encourage you guys to ask questions as we go along. You know, it's kind of boring for me to just hear myself talk the whole time. So, if we get some questions and some interaction, that would be great. Producer Caleb's going to be monitoring the questions. So, make sure you comment. All right, let's get started. Just a quick little about me. So I'm a CPA and a CFP and a CGMA, and I run a accounting firm based in Rock Hill, South Carolina. We've got about 35 people, and we focus mostly on tax. So we're dealing with tax all day. I'm also co-founder and CEO of WealthRabbit, which is a small business retirement solution designed for CPAs. And I've been advising put this on retirement plans, but I've been doing tax planning for a long time, 10 plus years, even though I'm only 22 years old. So I don't know how that math works, but let's get going. All right. So today I'm going to talk about the Big Beautiful Bill. That's what I'm going to call it. It's officially called the OBA, but I'm going to call it that because I think it's a better name. We're going to talk about the provisions that were set to expire. Then we're going to talk about the new individual tax law changes, the business tax law changes, and the estate tax law changes. All right. So we all remember the Tax Cuts and Jobs Act of 2017. This was President Trump's first term when they passed a big tax law. Almost all the individual provisions were set to expire at the end of this year. So what a lot of this new bill did was just make those original tax laws permanent. So if you'll remember, we had different tax brackets before. All the current tax brackets remain the same. The standard deduction is doubled from the old law. That's now permanent. We've got personal exemptions are eliminated. They're still eliminated. The casualty losses and miscellaneous itemized deductions remain gone. So if you remember before, we had tax prep fees, hobby expenses, employee expenses, which were the worst. And we're very glad as CPAs that we got rid of those, so we don't have to deal with that. The increased AMT exemption was made permanent. The child tax credit's now made permanent. So they got rid of the personal exemptions and increased the child tax credit. It's now $2,200 starting in 2026, an index for inflation. The $750K debt limit for deducting home mortgage interest is now made permanent. It was $1 million. They decreased it to $750,000. That's now permanent. And the piece limitation on itemized deductions is made permanent. That's if you're very high net worth, it limits the amount of itemized deductions you can take. So all that is made permanent. So a lot of the news you've been hearing about, like all this new stuff and how the taxes were going to go up, it's basically because these are all set to expire. Now they're not expiring, so we don't have to learn new stuff there. So that's exciting. Now we're going to get to the stuff that is new, and I'm calling this part the campaign promises. And this is what President Trump talked about during his campaign that he promised. And they basically are all only available during his term, and they're set to expire after 2028. And that's the new senior deduction, the tip income deduction. And I'm calling them, they called it like no tax on Social Security, no tax on tips, no tax on overtime. It's not really the case. They just create deductions for people. It sounds better that way, but this is truly for your clients. This is what it is. And the car interest deduction. So let's start with the senior deduction. So there's a new deduction that's $6,000 per senior, 65 and older. If you're married filing jointly, it's $12,000. And what's interesting about all these things is they don't affect. They reduce taxable income, but they don't reduce AGI. So it's kind of like the QBI deduction, the qualified business income deduction. Very similar for all of these things. So, but it's not an itemized deduction, which is good. So it doesn't affect itemized deductions. So basically, if you're a senior and you're 65 and older, you're going to get a $6K deduction, assuming you're not phased out. And we're going to notice these phase outs are very low for almost all of these four things. So the phase out starts at $75,000 for if you're single and $150,000 if you're married filing jointly. So that's a very low income threshold for this full thing to phase out. And this is only available for 2025 to 2028. Obviously, they could extend that after 2028, but under current law, everything is set to expire after 2028. All right, let's go to the no tax on tips. I put that in parentheses. So it's no tax on tips as long as you meet these requirements. So you can deduct. So it's a deduction of up to $25,000 of tips, and it has to be approved, an IRS approved industry, which customarily receives tips. And one caveat I should mention too, before we get too far into this, is like a lot of this stuff, this bill just passed basically a month ago today, a little bit more. There's a lot of regulations and guidance that are going to have to come out on this. One of that is which industries qualify for this tips credit. So it specifically says in the bill it has to be an IRS approved industry, which customarily receives tips. So we would think that would be restaurants, places like that, aka not accounting firms. Like you can't advise your clients, hey, I want to pay all my staff $20,000 and then the rest I'll get in tips so they won't have to pay tax on that. You're not going to be able to do that. And they're supposed to issue this guidance by October 2nd. We'll see if that happens, but hopefully by then we'll have a little bit more guidance on this stuff. And the phase out here starts at 150,000 single and 300,000 married filing jointly. And like the senior deduction, not an itemized deduction, but also does not lower AGI. And I say appears not to lower AGI because the bill is a little bit tricky. We're going to have to get, again, guidance on that, but that's the way it appears. And also only available from 2025 to 2028. No tax on overtime. So similar to the no tax on tips, also they have created a new deduction for overtime. The maximum annual deduction is $12,500 or $25,000 married filing jointly. And you only get this deduction if paid extra. So normally with overtime, you get time and a half. You only get it on that half. So just because it's overtime doesn't mean you get it all. It has to be over your regular amount. That's important. Phase out, again, modified AGI, 150,000 if you're single, 300,000 married filing jointly, like the senior deduction and the tip deduction, not an itemized deduction, but also not going to lower AGI, available from 2025 to 2028. And one thing on this, and also the tips, like there's going to have to be reporting, like they're going to have to change the W-2. There's going to have to be new forms created for this. So we're waiting for the IRS to issue that, because how are we going to know that paid time and a half, how much that was to put that on the people's tax returns? They're going to have to, the companies are going to have to report that. And those companies might have not been tracking that accurately for the beginning of the year because we didn't know this. So that's going to be a big mess that the payroll companies are going to have to work through, and probably we're going to have to work through. But more guidance is going to be needed on that. Hopefully we'll get that October 2nd, somewhere around there. Final of these is the no tax on the car loan interest. So you can deduct up to $10,000 of car loan interest per year. The loan has to be originated after 12/31/24. So it can't be an old car. You have to have bought the car in 2025. It has to be a new vehicle. It has to be for personal use only. And that loan has to be secured by the vehicle. So you can't get, I guess, an auto loan and try to deduct it, but you use that money for something else. And if you refinance, you can also do it, but it can't be on a used vehicle. Phase out start from 100K married or single and 200K married filing jointly. Must be under 14,000 pounds and final assembly in the U.S. And you have to supply the VIN on the tax return. So I'm assuming it will be like the EV credits that we've had, like the dealership is going to give you the VIN and the form. Again, we'll have to have guidance on that. Just to note on this, like to deduct up to $10,000 of car interest, that's a loan. That's you're buying a vehicle over $100,000. So you're spending a lot of money on this. Most likely, if they're spending $100,000 on a vehicle, they're going to be over that 100K single or 200K married filing joint. So this is going to be very, like, there's not going to be a big benefit for this for most of our taxpayers. And I just put the lenders will have to show a new form interest paid. That'll have to be told, and this is only available from 2025 to 2028. I'm going to pause there for a second and see if we have got any questions. Producer Caleb, anything?
Yeah, you have. I'm popping in, Zach, but you have one from Marie. She asked, "Is the car loan deduction just for American-made cars or all?"
The final assembly has to be in the U.S. That's what it says in the tax law. So they will supply a list. Like I assume it's going to be like the EV credit, and we'll get to that later. That's going to expire at the end of September. But for those, like if you bought a Tesla, they told you if you qualified for the credit. I'm assuming all the vehicles that will qualify for this, they will tell you if it qualifies for this credit, and they're going to have to send you like there's going to be a new form for this too. Like we're going to have to know based on the VIN if they qualify. So more guidance is needed on that, but the final assembly has to be in the U.S.
Then we have another one from Jonathan. Is the car loan deduction on itemized or above the line?
It's not an itemized deduction. I didn't put that in here, but it is. I'm pretty sure it's like the other two. I didn't put that in here. I don't think it's an above the line deduction, but I think it's like the tips and the overtime. I think it's the same. I need to double check that though. So Jonathan, I will check that after, and if you just send me a quick little your email, I'll follow up on that. But I believe it is like the other two or three.
Great. We have some more coming in here if you want to address them. Is the 10K max each yearly for interest?
Yep.
Okay.
That's
And
yearly.
then Tommy wants to know, will this only apply for personal vehicles, or can it apply to vehicles owned by an LLC or the Schedule C?
So it has to be personal use vehicles. You can deduct, like if it's used for a business, you have been able to deduct that interest before as a business expense. But this is only for personal use vehicles.
Great. That's all we have for now.
All right, perfect. Great questions. Keep them coming. All right, so now we're going to get to kind of the meaty stuff and the stuff that will affect a lot of you too. And for us CPAs that are listening, like this is the stuff that's going to affect our clients. So first big one, and this is one of the only ones after this that is limited. This expires after 2029. But this is the increase to the SALT cap. So SALT is state and local income tax. Right now, or prior to 2025, the SALT cap was $10,000, which just meant that you added up your state income tax that you filed, your property tax that you filed, and once that hit 10,000, that was the max you could do for an itemized deduction. They have increased this to $40,000, which was a big win, especially for those in high tax states like New York, New Jersey. This will be big. It's also indexed for inflation, so it goes up a little bit every year till 2029. The big thing here, though, is the phase out. So this phase out starts at 500K and ends at 600K. And this is the same for single and married filing joint, which is interesting too. So basically, if you're in between that phase out, that's a huge additional tax. I think the marginal rate someone calculated is like 56% for every dollar in that phase out. So this is where you can do planning as a CPA professional. If they're in that range, you want to try and get them out of there. So whether you do a retirement plan or you do some other tax planning to help reduce this is big. And also, as we get to towards 2029 or 2030, if we're trying to, time income, this could be a timing of income where we might want to push the income in 2030 instead of 2029 so we can get this deduction. So this is a planning opportunity for us. Also, you often have time. You can plan on when you pay some of these taxes, like property tax on your house normally is due, at least in South Carolina, January 15th. Most states are like that. So figuring out when you want to pay that, maybe you double up in some years so you can itemize, and then you don't do it the other years. So some planning tips and ideas there. We still think that pass-through tax is still going to be potentially better for this instead of doing paying individually. So the pass through entity tax just means you're paying the tax at the entity level, and getting the deduction there instead of paying it on your individual level. And we think this could still be better because this affects AGI. So this is going to lower your AGI. But you have to look at each client individually. So that's a big one. A lot of planning opportunities there.
Sorry to interrupt, we got a question. Does SALT cap apply to all 50 states or only for residents of California, New Jersey, Connecticut, and New York?
It applies to every state. Next thing, and if you have more questions, just keep them coming. They're adding an above the line charitable deduction. So you can now, without itemizing, you can now take a $1,000 charitable deduction or $2,000 married filing jointly. That's nice if you have itemizers. They're creating, starting after 2025, so in 2026, there's now a 0.5% floor of AGI for charitable contributions. So this is a planning opportunity too. So if you have a client that is planning on making a charitable contribution, 2025 is probably better than 2026. So you need to think about that. But the unused deductions do carry forward. And then the new law also permanently extended the 60% contribution limit for cash. So that just means you can deduct up to 60% of your adjusted gross income for cash. Here's a big one that's been in the news, the gambling losses. So they kind of snuck this in last second, and we're not quite sure why. But you can only take a max of 90% of gross earning as an itemized deduction loss. So I gave this example here. So if a gambler wins $100,000, but they lose 110, you're only allowed to deduct $90,000 of gambling losses against that 100,000. So in this case, the gambler actually lost $10,000 in total. He won 100, he lost 110, but he can only deduct 90. So that's going to really affect the the gamblers out there. So there's not really any planning involved in this other than it just kind of sucks if you're a gambler. So something to think about.
So Ronald wants to know, is miscellaneous deductions prior to 2017 brought back?
No, that was a permanent thing they got rid of and permanently extended. All right, let's go to the 529 plans. So the 529 plans, this is a cool little thing they added. So they expanded the use of 529 plans. So before you could use it for K through 12 and also college expenses, and that was pretty much it. You couldn't do all these ancillary things. But now you can use it for a lot of additional stuff, including SAT, ACT prep and fees, homeschooling, which is a big one, tutors, accredited test prep and fees. So that's the CPA exam, and also like Becker if you're doing CPA. And this starts for anything after the bill was passed. So like any expense after 7/5 or after 7/4, so starting July 5th of 2025, you can deduct for this. And it also doubled the amount you can use for these. I call them K through 12 expenses. So under the current law, like for college post K through 12, it's unlimited amounts you can use. Under current law, it was $10,000 for those K through 12 expenses. Now it's $20,000 per year per student. So that's a big planning thing, especially for certain states like in South Carolina where I'm based. We have an unlimited deduction for contributions to 529 plans that are in South Carolina. So this is a planning opportunity. If you've got your clients that are in private school and they're spending $20,000 a year, now they can basically put $20,000 into the South Carolina 529 plan and then take it right back out and get a deduction. That saves them approximately $1,300 in tax per year. So if you're not sure about your state's deduction, the best website for that is savingforcollege.com. They rank all the 529 plans, and they also go through each state and what your deduction is. So if you're not sure, and we have clients, all over the country too, I've got to look it up because I don't know all the state rules. But that's something that we should monitor, and we've got to tell our clients about this because this is going to be a big potential thing.
So Marie asked, did you say the 529 plan now includes CPA exam and prep expenses?
That's correct. You can use the 529 plan for accredited test prep and fees, which is like the CPA exam. So that is correct, which is nice. All right, Trump accounts. These are new accounts for minors. And what's nice is the government's going to give any child born between 2025 and 2028 $1,000 for their Trump account. So if you're lucky enough to be born between 25 and 28, maybe you can accelerate the timing of a birth to 2028. That's a joke. Don't tell your wife to do that. But they're going to get $1,000 per year or per child. Not per year. They get $1,000 if a child is born between 25 and 28. You're also allowed annually to put in $5,000, and that's indexed for inflation starting in 2027. Employer contributions are allowed, and this could be a possible new fringe benefit. We'll need guidance on this. The Trump accounts are kind of the wild, wild west right now. We don't really know a lot about them. All we know is that it's basically, they're kind of like IRAs. You can contribute to them as a child. After they turn 18, it follows the same rules as IRA, but you can use some of the expenses after that for education, first-time home buying, etc. So we need a lot of clarification on this. But the big thing to think about right now, you can't start contributing these until July 5th of next year, 2026. So we'll have a lot of clarification in the next couple months. But I think for the CPAs and stuff is thinking mainly about this employer contribution. Like if this becomes a deduction in some way, that would be something that we might want to advise our clients on. And then we'll have to know more going forward. I will say that WealthRabbit, which is, I'm a co-founder of, we're going to offer these Trump accounts. So stay tuned for more on that.
We have a couple of questions that came in for this. Ashley asked, does the limit affect homeschooling and tutors too, or just K to 12?
So that's for the 529 plan. You can use up to $20,000 a year per child on homeschooling.
And then we got Jessica who asked, on the 5K total, does that include the employer contribution?
Yes, that does include the employer contribution. There is a provision in the law where charities and like private foundations can give above that 5,000 to Trump accounts for people. I'm not quite sure how that would work, but that employer contribution does go to the 5,000. All right. One of the bad things from a tax perspective is the clean energy credits are going away. So the electrical vehicle credit, which was $7,500, is gone after 9/30. So if you have clients that were thinking about buying a Tesla or other type of EV, like you got to tell them if they want the credit and they qualify for the credit. There were income phase outs. I think it was 150,000 single and 300,000 married filing joint, if I remember correctly. They've got to have that vehicle by 9/30. So that's really like the thing that's expiring the fastest. So if you want to tell your clients, tell them now. The home improvement credits, those were like for new HVACs, new windows, stuff like that. They all expire at the end of 2025. So if you've got a client that's doing a home renovation or doing improvements to their primary residence, that you need to tell them they need to pay for that, and that needs to be put in service by the end of 2025. The solar credits also end at the end of 2025. So again, if they were thinking about putting solar credits, they got to do that by the end of this year.
So it looks like we got someone else asking about the Trump account. Robert wants to know, can self-employed people do the $2,500 employer contribution, or does it have to be via W-2?
It's going to be an employer benefit. We're not quite sure exactly how that's going to work. So we need more guidance on that. But potentially, I would think if an employer is allowed to do it, the Schedule C could do it. But we need guidance on that.
Perfect.
It's a good question. Okay. All right. Opportunity zones. So this is a nice thing that they've expanded. So we had the original opportunity zones. And an opportunity zone, if you don't know, it's a designated area by the government that is if you put money, it has to be designated, and it's mostly for places that they want economic development. So each state designates their opportunity zones, and if you invest in there, you can get a deferral of gain, and you can also get a basis step up. So the original opportunity zones are set to expire at the end of 2026. So now we have new opportunity zones, and they're going to be a rolling 10-year period. So the opportunity zones will start, there'll be new opportunity zones that start January 1st, 2027. And investors, once again, can receive the benefit of gain deferral. So basically, you can defer your capital gain for 5 years. And unlike the previous opportunity zones, which you could defer it until this cliff. So basically, anytime in the last 10 years, if you put money in the opportunity zone, it all got deferred until 2026, and that's when you pay the capital gain. This is basically 5 years from when you invest. So that's a difference from the old law. And if you hold it for 5 years, you get a basis step up of 10%, meaning you don't have to pay tax on 10% of the original gain. So that is the benefit there. If you put the capital gain, not only are you deferring it 5 years, but you're getting a basis step up of 10%. So that's a nice thing for your clients, especially those with large capital gains. It's giving you a way to put it into a future year and also get a basis step up. And if you hold that new property for 10 years, the gain on the appreciation of the initial investment is not taxed. So let me give an example on this. Let's say you have $1 million that you're deferring and you put that into an opportunity zone. And let's say in 10 years, they sell the property for 10 million. You don't have to pay any tax on that $9 million of appreciation. You still have to pay tax after the 5 years on that $1 million, but you don't have to pay it on the appreciation. So that is a good deal. I will say that a lot of these plays are not 10 years. Like most of the investments, they're a 5 to 7 year flip that I've seen. But so you're not really doing it for that 10-year appreciation. You're doing it for the capital gain deferment. But there are some that will last for 10 years and you will not have to pay tax.
Gary, we had a couple questions come in. Mason wants to know how much red tape is there to apply for a QOZ tax benefit, and would it make sense for someone buying single family homes or just large funds?
So I will say from experience, we have had some clients that have done it individually. It's not super hard to do. You have to file a form. I don't remember the form number the first year for the opportunity zone. It can get tricky if you have more than one people trying to invest in this. There are a ton of funds out there that are opportunity zone funds. If you have a client who needs this, like you can find them an opportunity zone fund. But I will say it can be done individually. The single family homes, like that's a little trickier, I think, because they've got to be in the opportunity zone, and you've got to figure out like if you're deferring the gain in there, it's got to make sense. But it can be done. An opportunity zone has to be held in a partnership or a corporation, I believe. So you can't like own it individually. You have to set up a partnership or an S corp to do that. So that does get a little trickier. Like if you're an individual investor and you're trying to do an opportunity zone, like you've got to think through some costs of entity setup and filing those forms and stuff.
Great. And then Nicholas wants us to know, does this update old opportunity zones, or are they still only deferred until 12/31/2026?
Did not. The old opportunity zones are the same. So these are new opportunity zones starting January 1st, 2027. All the old ones, the rules are the same. They still have to pay the tax next year in 2026.
I see one more question here from Brian. My client pays independent contractors and files Form 1099 NEC. Did the $600 threshold change?
Coming up.
That's later, yeah.
That's coming up.
Great.
We're going to get to that.
Yep.
All right. Okay, so those are basically the individual changes. We're going to get to the now we're talking about the businesses. So the pass-through entity tax. So the PTET tax stands for pass-through entity tax deduction and QBI deduction. So these were set. The QBI deduction was set to expire, I think, for certain things, but either way, they're now permanent. So the PET tax and the QBI are made permanent. There was talk that the PET tax was going to go away, but it didn't. So that is very good for our clients. There's also a new thing in the law where you get a minimum of $400 QBI benefit. So the QBI is qualified business income. So if you're a qualified business, you can take a 20% deduction of your income as a QBI deduction. There's a new $400 benefit for that, which is small but nice. And the phase outs. So there are phase outs for specified service. So if you're like an accountant, you don't get the QBI deduction if you make over a certain amount of money. These QBI phase outs now are a little bit better. It's now 75K over the threshold for single and 150K for married filing joint. I think it used to be 50 and 100. So the phase outs are a little bit wider, which is a benefit. So in kind of overview, not much change here. This was basically extended, but slightly better for our clients. All right, here's a big one, and this is the R&D. So under previous law, starting in 2022, if you had R&D expenses, you had to amortize those. If they were domestic, you had to amortize them over 5 years. If they were foreign, you had to amortize them over 15 years. This new law got rid of the amortization of domestic R&D expenses. So if you have domestic R&D expenses, no longer have to amortize, which is big. Now, they also went back and said if you're a small business taxpayer, you can go back and amend 22, 23, and 24 to take off the amortization. Small business taxpayer means average of $31 million or less in sales over the last 3 years. That's probably most of our clients that are on here or most of the businesses that are listening to this. So you can either go back and amend 22, 23, and 24 to take off this amortization, or you can deduct all those 3 years. So basically take one big expense for those 3 years in 2025, or you can take it over 2 years. So 50% 25, 50% 2026. So this is a big planning opportunity for your clients that had R&D. I will say we've looked at this for most of our clients. I would say like 80% is going to make sense to amend. It depends on the amount of credit. If it's a $2,000 credit, like that's not going to make sense to amend. But if it's a higher credit, it's going to make sense to amend, mainly because you're going to get back this 7% interest from the IRS because that's been the interest rate. So that's a nice interest for potentially 2 or 3 years that you'll get. So, but you got to do the calculation, and it also depends on the client what tax bracket they were in. If they were in a low tax bracket in 22, 23, and 24, but in 25 they're going to be in a big tax bracket, like you just wait until 25, take the deduction when they're at a higher tax bracket. So you got to review this with your client. This is a great planning opportunity, a way for you guys to make money on advising your clients on this.
Kelly had a question back to the PTET and QBI. She wants to know, is the phase out of 75,000 and 150,000 on the AGI or something else?
Yeah, so this is not the threshold. This is not the phase out number. I didn't put that in here. I have to look it up real fast. Maybe someone could Google it. But I think the phase out starts at like 150 or 200 for single, and then it's 300 or 400 for married filing joint. So what this did, it used to phase out over $50,000 if you were single. Now it phases out over 75,000. So I'm just going to say that the phase out starts at 150 AGI. Now it won't fully phase out till 225, if that made sense. I don't have the exact numbers on here, but that's the benefit here. So it's not phasing out at 75K AGI. It's phasing out at higher than that. It just goes for a wider range, if that makes sense. I should have put the QBI phase out range here, but I didn't. All right, here's another big one that I think is going to be really big for your clients. So 1202 stock. So just an overview of 1202 stock. That is qualified business stock. And in order to be qualified business, you have to have be a C Corp. You have to be a qualified business. You can't be in consulting, like professional services. This pertains a lot when you have software companies or manufacturing companies. And when the original stock is issued, it has to be their gross assets have to be $50 million or less. Now it's 75 million. So that's a qualified business. And now under the new law, there's now a $15 million exclusion for stock issued after July 4th, basically the date of the bill. It used to be 10 million, now it's 15 million. They've increased that gross asset test from 50 million to 75 million. And the exclusion also starts at 3 years instead of 5 years. So under the old law, it was $10 million. You had to hold the stock for 5 years, and the gross asset test had to be 50 million. Now they've increased it to 15 million, 75 million assets, and you can get a 50% exclusion after year 3. And one big thing too is this is indexed for inflation. So the 15 million is going to go up every year. So if you've got basically a small business, a qualified small business, and they're a S corp or a partnership now, you need to think about if it makes sense to make them a C corp and get this 1202 stock exclusion, because this can be very big for clients. Like moving it from 10 million to 15 million. I mean, if you're in, that's a 1.6 or $7 million tax savings there. So something really big for your clients, especially those software companies. We have a lot. That's mostly our clients. They're software startups. This is big for them. So something you really have to think about. The other big thing, the 100% bonus depreciation is back. The key with this is the asset has to be placed in service after January 19th, 2025. So basically, when Trump was inaugurated, I guess there's like 12 hours when Biden was still president where you could still get it. But basically, this is when Trump went into office, 100% bonus depreciation. So that's the important date to think about here. 100% bonus depreciation just means you can depreciate or basically write off everything, 100% of what you bought. So there's a new thing for qualified production property, and this is for manufacturing. If they're building a plant, they can potentially write off like their entire plant if it's a qualified property. We need more guidance on this. But most of you, for your clients, this will be, the 5, 7, 15-year property that qualifies for bonus depreciation. You'll now be able to do 100%. They also increased the cap of the Section 179. So the new cap is 2.5 million. It's up from 1.2, and the phase out begins at 4 million. And you still got to look at Section 179 because a lot of states recognize Section 179 but not bonus. Like South Carolina is one of those, for instance. So South Carolina, it follows federal on Section 179 but not bonus. So most of our clients that aren't very capital intensive, they'll still benefit, and it'll be better for them to do Section 179. But bonus is back. One other thing too that they changed, the business interest deduction, the 163J. So you basically can't deduct business interest if you have certain losses. It used to be based on the net income just before interest and taxes, but now it's based on EBITDA, which basically adds back depreciation. So a lot more people will be able to deduct the business interest expense. Here's another one that's kind of cool that will affect a decent amount of people. The tips credit. So there's a tips credit, used to basically only be for restaurants, but they've expanded it to beauty professionals. So you can now get a tips credit. And this barbershops, hair and nail salons, aesthetic services, and spa provided services. So there's a ton of new businesses that are starting up, especially in the spa provided services. Think Botox, red light therapy, all those stuff that my wife does. Those tips can now be part of that credit. So if you've got clients or you're a business that qualifies, this can be big. Like we had one client that just based on last year's numbers, they're going to get a $12,000 tip credit. So that's pretty cool. All right. We had the question on the 1099 thresholds. So they're increasing it starting in 2026. So 2025 still falls under the old law of $600, but starting in 2026, we are moving to, if you pay someone less than $2,000, you don't have to issue them a 1099. And same thing with 1099Ks. That's going to $20,000. They had lowered that to $600. And just note that that one's not indexed for inflation, but the $2,000 is indexed for inflation. So it'll be $2,000, and then every year it'll go up a little bit. So that is nice for our businesses that we don't have, hopefully might not have to file as many 1099s, but I still recommend that everyone still gets a W-9 for everyone that they pay. And you can use Tax Bandits, which is also a sponsor of this webinar, to do that. All right, any questions before we get to the estate tax?
Nothing's come in so far.
Okay. All right, this is the last thing, and this was also big. So the estate and gift tax exemption is 15 million starting next year, and indexed for inflation. This was it was like 13 and a half or something like that in 2025, and it was set to go to half of that to like 7 million. So they made this 15 million and made it permanent. So basically, if you die and you have less than $15 million in your estate, you don't have to pay any estate tax. And they made the GST exemption, which is the same $15 million in index for inflation. So that's good for tax planning. I know a lot of us were waiting on that to see if we needed to do any trusts or anything for our more high net worth clients. But now with the $15 million exemption, you still have to worry about it for people over that, but 99% of the population has less than 15 million, and we're good. All right. That's basically the big, beautiful bill in a nutshell. The only things I didn't go over, there were some foreign stuff. There's also stuff for foundations for colleges. That doesn't really affect, I think, most of us. And there's some changes into some guilty tax, some other foreign stuff. So if you have foreign clients, you need to look that up. I didn't put those in here. And we need a lot of clarification on those too.
Yeah, I don't know what he was referring to exactly, but Jared asked, is the $20,000 index for inflation?
I think you're referring to this 20,000 for the 1099Ks, and no, it's not indexed for inflation.
Okay. And we also have Miriam earlier about the I forgot what it's called, but she asked if you're a single member LLC, you can't take the opportunity zone.
That's correct. The opportunity zone has to be a partnership or a S corp. Like you would have to create a partnership for that new basic opportunity zone. You're buying a new piece of property that has to be in a partnership.
Got it. And then David wants to know, were there changes to the business meals deduction? Heard it was going away on 1/1/26.
Yeah, so that I actually should have put that in there. Yes, they did not extend those. So there was 100% deduction if you had meals in your office, like you provided meals for your staff inside your office. That's going back to 50% now. So that is changing after 2025.
Got it. And then Robert wants to know, does the new SALT cap prevent you from taking PTET?
No, the passenger entry tax is still there. And I put that on the slide, but passenger entry tax is still probably better instead of the SALT cap because that lowers your AGI. But you got to look at that for each client, and that's a chance where you might want to time something. Maybe 1 year if you know you can get itemized by front loading your property tax. Maybe you do it in 1 year and then do passenger entry tax in the other. Potentially, you got to look at each client. But passenger entry tax is here to stay, which is nice.
Great. That's everything I see right now. So thank you, Jason.
All right. Just if you want to copy these slides, just email me after. You can just do jason@wealthrabbit.com. Here's my LinkedIn if you want to follow me. Sometimes I post stuff. And I will say that if you're a CPA or for WealthRabbit, we are offering 50% revenue share for the rest of the year for any client you put on WealthRabbit. You just need to use code earmark50. So do that. And that's it for me. Hopefully you guys enjoyed it and learned something. And I'm happy to answer any questions after this seminar. You can just email me or call me at that line right there.